Open your phone, tap your banking app, and look at your balance. The interface feels safe, quiet, and perfectly still. We are conditioned to picture that digital number as a physical stack of cash, sitting quietly in an impenetrable steel room. But that screen is a comforting illusion, designed to hide a highly active, chaotic reality. This digital summary masks the physical movement of your deposit, obscuring the path your money takes once it leaves your sight. Take HDFC Bank. They pull in massive revenue, around 60,000 crore rupees annually. They generate this wealth without manufacturing physical goods, refining oil, or selling a monthly software subscription. How exactly does a corporation generate a multi-billion-dollar revenue stream without selling a single traditional product? The bank's true product is actually your money. When you hit deposit, your savings account becomes part of the bank's active deployable inventory. Let's track a specific, everyday transaction. You deposit 10,000 rupees into your savings account. This diagram shows that initial 10,000 rupee block splitting apart. 1,000 rupees is locked in reserve to satisfy regulations, ensuring enough cash for daily withdrawals. The remaining 9,000 rupees is shipped directly into the broader economy. Within days, your specific funds are handed over to someone else to finance a 30-year home mortgage or to buy equipment for a local coffee shop. Your personal savings account balance operates as a digital receipt for money that is currently in a stranger's hands. Since you provided the initial capital for that loan, you are compensated for your contribution. In this diagram, the bank pays you a 3% interest rate on your original deposit. Simultaneously, the borrower pays the bank a steeper 9% rate. The gap between the 3% paid and 9% charged is the net interest margin, or NIM. This invisible mathematical gap, rather than account fees or physical products, is the engine of global banking profitability. On a single 10,000 rupee deposit, the margin harvested by the bank seems insignificant, but scale that mechanism up to include millions of customers, depositing portions of their paychecks every single day. That is how you reach HDFC's 60,000 crore rupees in revenue. It is the aggregation of these microscopic margins. It creates a continuous looping system. Deposits flow in, loans flow out, and the margin is harvested from the middle over and over again. Global financial institutions leverage these aggregated micromargins to build their massive revenue streams, one retail deposit at a time. The idea of a bank as a secure, passive storage facility is a misconception. These global institutions operate as high-speed financial routers, connecting individuals with surplus capital to those with capital deficits. You act as the primary supplier of the raw materials, keeping this ecosystem alive. The next time you open your banking app, remember that the balance on your screen isn't resting in a vault. It is a live participant, funding a vast economic engine.